We are going to talk about how you can get a mortgage, and I'm going to help you to really understand the home buying process. All right, so our goals today, this is what we will accomplish and the different things that we'll touch on throughout this course. So we'll first talk about the advantages of owning a home. We'll talk about the different loan programs that we have available at Michigan Mortgage and how those might be best suited for you in your unique situation. We'll discuss the costs of being a homeowner. I'll help you to understand how your credit score affects the options you have. We'll talk a little bit about the pre-approval process and how you can get that completed. And of course, I'm here to answer any questions you have today. All right, so why buy instead of rent? This is a question that we get all the time, just because renting is something that is so common and so many people are doing it. But there certainly are some very distinct advantages from owning your own home. And first and foremost, we call it an investment. Your home tends to increase in value over time, especially in the last 5 years. Home values in West Michigan have really increased, putting homeowners who plan to sell in a great position. You build equity over time as your home is worth more than what you paid for it. When you go around and turn to sell it, there's a little extra money in your pocket. And the interest paid on your mortgage is typically tax deductible. Obviously, you'll need to consult with your tax advisor to verify that, but in most cases, that interest is tax deductible. It's also yours. When you own it, you can personalize it. You make the improvements. You paint, you decorate, you do all of those things that really make it feel like your space. And of course, there's more room. Oftentimes when you're renting, you maybe don't have the big backyard or the extra garage space. But when you own a home, you can really find something that meets your specific needs. And of course, purchasing a starter home is a great way to build personal wealth. It's a great place to start. When you sell it and you make a profit, you then can take that money and put it back into your second home or your dream home or whatever that may be. So certainly some distinct advantages here when it comes to home ownership. And of course, you want to stop paying someone else's mortgage. When you're renting, you're paying their mortgage. You might as well start paying your own. So how do we begin? I think for most people, it seems like a very cumbersome process. A lot of work, a lot of stress, and at Michigan Mortgage, our goal is to make it as easy as possible and make it fun and exciting for you. So I'm hoping that I can break it down a little bit so you better understand. So first and foremost, you need to find your home team of experts. We recommend that the people that you partner with throughout your journey, so your realtor, your lender, and your insurance agent, we recommend they're all local. With the way things are in digital and online, you can work with someone from anywhere, but if you work with someone that's local, they know the market. They know the properties and people. They're also a face, they're a name, they're probably a cell phone number. You can text, you can call, you can meet them face to face, and there's just a lot of benefits of working with someone that's close. After you have your team assemble, your advisors, your experts, you have them in your corner, you want to complete the pre-approval process. We'll talk more about this a little bit later, but that's kind of 3 steps. So first, you submit your loan application. That's where we ask kind of the basic questions: your name, your contact information, employment history, your income, your debts, that sort of thing. You also have to supply all of the necessary documents, W-2s, pay stubs, uh, bank statements. There's a list, obviously, depending on your unique situation. And then, of course, you need to explore your loan options. And this is where your lender will come in. They will look at each customer on a case-by-case basis and help you decide which loan program is the best one for you. We will talk about 4 loan programs later. So hopefully you may have a little bit better idea of what exactly you are looking for. And then, of course, step 3 is consulting with your real estate agent. After the paperwork is done and you get that pre-approval, that's where you can go out and you can start looking at homes, decide where you want to live, what's important to you, what's your must-haves, what's your budget, that sort of thing. So that's really when most people, I think the fun begin, because looking for homes in that search really is a pretty exciting part. And when it comes to your home team of experts, if you don't have a real estate agent or a relationship with a real estate agent, or don't have a relationship with an insurance agent, that is something we can help you find. We have a pretty wide net of experts that we work with, that we recommend, so we can help you find the best match for you depending on what you're looking for and what area you're looking for. So keep that in mind too, that it's okay if you don't have your team assembled yet, because we can help you do that when the time is right. All right, so Home Buying 101. Let's kind of get down to the basics of home ownership, walk through the process, and see kind of what that looks like. So what determines your ability to get pre-approved? So first and foremost, that is your credit history. Once you call us and we get your information, you will give our team at Michigan Mortgage permission to pull your credit, and we will use that to determine your interest rate, what you qualify for, what loan program is best for you, how much down payment you need, all of that good stuff. We also need to know your employee status, where you're employed, how long you have been there, and then, of course, your income. And then we'll need to know if you have any other sources of qualifying income. That includes things like Social Security or child support, things like that gets added to your income every month. We'll also take a look at your existing debts. When we pull your credit report, all of your debts will show up. So we will have a really good idea of what you qualify for and how much you can afford to spend on a home. Then we will have to talk about the down payment, how much money you have set aside, you have saved, so we can figure out the loan program we need. And then, of course, we can really dial everything in and start the home search process. So one of the questions at Michigan Mortgage that we get most often is all related to credit. I think credit is something that is a little bit cumbersome. It's kind of hard to understand, and of course, there's just a lot of factors that go into it. So for those of you that monitor your credit using a Credit Karma or something like that, that's a really great place to start, so you can see how your different debts and your payments really impact your score. But something to keep in mind, when we pull your credit for a mortgage, your score may be a little bit different. The score that Credit Karma shows is a tad different than a mortgage credit pull. So just keep that in mind, that although Credit Karma is great, it's not totally accurate when it comes to the mortgage pull. So what determines your credit score? If you look at this chart here, there's really 4 main areas that the credit bureaus look at when they calculate your score. 20% is new credit or types of credit. Types of credit include credit cards, medical bills, school loans, car loans, that sort of thing. 15% of your score is determined by your length of credit history. 30% of your score is attributed to the amounts owed. So what we typically recommend, if you have credit cards, you want to keep your balance below 30%. That should always be your goal, because if you can keep that below 30%, the credit bureaus will reward you accordingly. So keeping that balance below 30% is a really great way to kind of grow that score and get you improving. But of course, as you can see here, 35% of your credit score is determined by payment history. That is by far the most important thing that the bureaus look at when they're determining your score. Because of course, if you're making your payments on time, then us in the mortgage world will assume that you'll be able to make your mortgage payment on time as well. All right, so a few important notes. So your credit score is also called your FICO score, and essentially it's just it's an indicator of how you manage your debt. So again, I said that, the history of making payments on time, if you make your payments on time, it's a good indication that you'll make your mortgage payments on time. And so why is your credit score so important? First and foremost, your credit score will help us determine your interest rate. The better the score, the better your rate. And of course, the lower your rate, the lower your monthly payment. Your credit score will also determine what loan program you qualify for. All of the different programs have a little bit different requirements. And it can also impact what your lender requires for a down payment. So it essentially, it really impacts how much you can borrow. The good thing is, though, that you don't need an 800 credit score and 20% down to buy a home. Your credit score is very, very important, but there is a little bit of wiggle room in that score, and you don't need to be perfect. And just a little tip to when you're working with a lender and they are pulling your credit, make sure you're requesting a copy of your credit report. It's great to have on your records. It's also really good for you to look at, to monitor, to make sure that everything you see is in fact correct. We live in a world where, identity theft is more common than we would all like. So if you're getting copies of your reports, then you can make sure that everything you're seeing is actually attributed to the debts that you have. And of course, your lender should have no problem providing that to you. All right, so before we move on, I know credit is it's kind of a hot button item. So if anybody has questions about credit, we're going to talk about down payment next. So I just want to make sure that I'm addressing any questions, concerns that you have before moving on. All right, well, let's talk about down payment. Other than your credit score, this is another one of those areas that we do get a lot of questions about. And I think that's because there is this misconception that you have to have 20% down to buy a home. And as you'll see later, sometimes you can buy a home with little to no money down, depending on some of the different qualifications that you have. So it's certainly the flexibility is makes it less of a challenge, especially for first-time home buyers. You may be able to buy a home with little or no money down, and some home buyers may even be eligible for down payment assistance. At Michigan Mortgage, we work pretty heavily with MISHDA. That is the Michigan State Housing Authority. And they have some down payment assistance programs that have really helped some of our home buyers really get in their home and get their foot in the door. So if that's something that you think you may be interested in, feel free to reach out to me after the fact, and I can connect you with one of our MISHDA loan experts and they can explain more about that program and how it works and how it can really help you. Um, and of course, we want to make sure that not only you are comfortable and you're prepared for a down payment, but you have to factor in those closing costs too. Those are the costs that you pay at closing on top of the down payment. So title work, home inspection, appraisal, the recording fees, that sort of thing. So we really want to make sure that we are all honest and upfront with each other from the very beginning, because the last thing you want and we want is to get to the closing table and you need to bring more money than you're capable of bringing. So make sure that you're talking with your lender up front about what you're comfortable spending for a down payment. And of course, supplying your bank statements will help us better understand too really what kind of assets we're working with. And so how much can you afford? Again, we're going to look at your credit score, your down payment, your assets, and we also look at what is called your debt to income ratio. This is where your credit report comes into play. So what we do is we look at all of your monthly debts. What are the monthly payments you have? And then we look at your monthly income. So your debts are things that are on your credit report. So that is and your car loan, that's student loans, any credit cards you have. That does not include your electric payment or your cell phone bill or your insurance. It just includes those lines of credit that you have. So obviously debt to income is the percentage of your income that's taken up by your debts, and that will again help us determine the specific amount that you qualify for when purchasing a home. It's also important to note that your debt to income ratio includes the anticipated house payment for the house that you're looking at. So that ratio it gets adjusted a little bit when you figure out exactly how much you want to spend. And then, of course, certain loan programs have different qualifying guidelines. So, for instance, a conventional loan typically requires a lower debt to income ratio than maybe an FHA or a VA loan. So, again, we'll get more into that later, but the debt to income ratio is really where your qualifications come in. The other thing too that's really nice is once we have your credit report, if you have a couple of debts maybe that are really close to being paid off, or if you were to pay it off, it would give you so much more buying power. Our loan officers can really look at your credit report and help you make some small changes so you're able to finance a little bit more money, if that makes sense. So there are some things that we can do too to try to give you a little bit of advice. We're certainly not credit experts, but our loan officers have been in the business long enough where they can analyze your reports and really help you kind of maximize your dollar. And of course, that's why it's so important before you house hunt to get pre-approved, to go through this process, because the last thing you want to do is fall in love with a house that you can't afford. So now let's talk about that mortgage payment. We talked about credit, talked about down payment, we talked about debt to income, but now let's talk about the payment itself. And once you find your dream home, what is that payment going to include? First and foremost, it's your principal. It also includes your interest. I'm sure, as most of you know, interest rates have been low for months. They're great right now. They're better than they have ever been. So if you're on this class and you're thinking about buying a home, you've certainly picked a great time to do that. Your monthly mortgage payment also includes your property taxes, and then it includes your insurance. Because we can escrow your property taxes and your insurance into your monthly payments, which means instead of you getting property taxes in the mail twice a year, we'll set up an escrow account and we'll take X amount of dollars every month. And then the mortgage company will distribute that money. So instead of having to pay two large payments up front, when those taxes come due, we'll collect a little bit over the life of the loan and put that into an escrow account. And of course, the same thing works with homeowners insurance. Instead of paying that large lump sum once a year out of pocket, we'll collect a certain percentage every month. So that money is already set aside and you're not worrying when that bill comes in the mail. Sometimes it is important to know that your mortgage payment may include what we call PMI. PMI is private mortgage insurance, and that is typically added to your monthly mortgage payment if you do not put 20% down. So obviously 20% down is a goal. As I mentioned earlier, you don't have to put 20% down, but private mortgage insurance would then be added to your monthly payment. And of course, your loan officer will walk you through all of that and show you the breakdown and what that kind of looks like. So which loan type is right for you? As I mentioned earlier, there are so many different programs out there, a ton of flexibility. So we'll look at the 4 programs that tend to be the most popular and kind of break those down so you can have a better idea which one may be best for your situation. So there are really 2 different types of loan programs. We have conventional loans, and then we have unconventional loans. So the difference here, conventional is not insured by the government. I guess that's just the simplest way to explain them. And then the unconventional loans, those are the loans that are backed by the government. So they're FHA, they're VA, USDA, Department of Ag. So that's really the big difference. And you'll see a couple key differences later. And in the competitive market, which is what we're in now, sometimes conventional offers tend to be a little bit stronger, just because they are a little bit harder to qualify for. So something to keep in mind as you're going through the process. So again, conventional loans are not insured by the government. They're backed by Fannie Mae and Freddie Mac. They have lower debt to income ratio thresholds, and they typically require a little bit higher credit score. So as you can see here, a 680 is a pretty good aim if you're thinking conventional is the way you want to go. And then if you don't put 20% down on a conventional loan, the mortgage insurance or that PMI, it tends to be a little bit more expensive than some of the other loan programs. And then the unconventional loans, as I mentioned, are insured by the government. So these programs, because they are insured by the government, tend to have a little bit lower qualifications and a little bit lower down payment requirements. So these are great programs for first-time home buyers. So the 3 we'll talk about today, there's FHA, VA, and then USDA. So a VA loan is intended for former and current military members. There is typically no down payment on a VA loan. There is no PMI, so no private mortgage insurance, which is great, having no money down and no PMI. And the funding fee may be waived for disabled veterans. The only stipulation, or the main stipulation in a VA loan, is if you want to go this route, it has to be your primary residence. So you typically can't do a VA loan if you're looking to purchase an investment property, a rental, a lake house, something of that nature. But if you're a veteran or active military, this is certainly a really great program, and it's one that you should consider given the cost savings there. And then there's an FHA loan. Again, low down payment, 3.5% down. It also allows for seller concessions. That means that when you are writing your offer with your real estate agent, you can ask that the seller pays for some of the closing costs, which then means you have to bring less money to the closing table when you purchase the home. This is something that your lender will work through with you, and they will suggest exactly how much money that you should be asking for. So we make sure all of your bases are covered. And FHA loans also allow for gift down payments. Essentially what that is you have a friend or a family member who is willing to give you a gift, a certain amount of money that you can use for your down payment. And then they have to submit a letter to your lender explaining that gift, and there's a few parameters there. But with FHA, you can use those gifts to kind of help you cover that 3.5% down payment. And then, of course, we have the USDA loans. These are also called RD, or Rural Development Loans. They are pretty popular in our area because a lot of the areas surrounding us are considered these rural areas where these loans are able to be used. They obviously can't be used everywhere, but if you're looking in a rural area, this is a great option to explore because, as you can see, there is no down payment and there's typically lower PMI. So again, conventional is a pretty standard loan program, 5, 10, 20% down. But if you need a little bit more flexibility, consider VA, FHA, or USDA. They're all really great programs for first-time home buyers, and can really help you get into that dream home if you don't have quite as much money set aside in the bank for a down payment. All right, and I also wanted to quick touch on fixed rates and adjustable rate mortgages. I think in the past, adjustable rates tend to price a little bit better, but given the conditions of the market right now, majority of buyers are using fixed rate mortgages, which means your interest rate for the life of your loan, whether that's 10, 20, 30 years, will remain the same. There may be some instances where you want to use an adjustable rate mortgage. That means that maybe the first 5 years your rate will be fixed, but after that, that rate will be adjusted on a yearly basis and can go up or down depending on the market. But of course, if you're working with a local lender who's willing to advise you and walk you through the process, they will know which loan is obviously best for you. So again, the loan programs that we discussed tonight offer a range of finance and down payment options. And remember, interest rate is only one component of obtaining the right mortgage. And of course, when you work with an experienced professional, they can help you to really select the loan that best suits your budget and your goals. So next, we're going to move on to the process itself. There are really 6 steps that I want you guys to be aware of, so you know what to expect as you're working through this. So if there are no questions, we will continue on to that. All right. So the 6 steps to buying a home. Step number 1. This is where you are going to do all of the legwork to really get the process up and running. Again, we'll start with the loan application. This can be taken in a few ways, in person, over the phone, or if you prefer technology, you want something that's easy and convenient, we actually have a mobile app that allows you to apply for a mortgage right from your phone. You can answer all of the questions, submit all of your information, and when it comes to providing your income and your asset documentation, you can actually use that app and take photos of your W-2s and your pay stubs and your bank statements and submit them right there digitally. So you don't have to worry about dropping documents off to us or faxing them in or emailing them or any of that. You can do everything right through the mobile app. After we have your loan application and your documents, that's where one of our loan officers will sit down and really analyze your unique situation. We will determine which loan program is best for you, what's your interest rate, what's your down payment requirements, and whether or not we're asking for seller concessions. And when we have all of that information, we will put it in a pre-approval letter, and we'll share that with you and your agent, and that's when you start shopping. So step number 2, you're going to review your pre-approval with your realtor and discuss your different purchase options. This is where you will formulate your plan and see what homes fit into your budget. There's a lot of great resources out there that you can look up online to really see what area you want to live, what are the schools like in that area, what other things do they have going on in the community, restaurants, activities, that sort of thing. So if you have a plan, so you know how many bedrooms, how many bathrooms, what zip code, that sort of thing, your realtor can help you put together a really great list. And oftentimes they can set up sort of a unique portal for you. So those listings are emailed to you and you can check them out and decide if you want to go see them in person. And then step 3, this is where you really start the shopping. Stay focused. Don't get discouraged, especially in a competitive market that we're in right now. We're seeing a lot of bidding wars. We're seeing homes sold before they're even listed. So just don't get discouraged. Know that your realtor and your lender, they're going to be in your corner and support you and help you get into that dream home. And another quick tip that we always try to tell people, if you start the pre-approval process, try to avoid any big changes between that time and when you've closed on your loan. So don't go out and buy furniture or a new car. Don't open a new credit card. Don't change jobs. Anything that could change how much money you make and what your debts are can really impact how much money you qualify for and what home you're able to purchase. So try to limit any excessive spending during the process. All right, so after step 3, right, you found your home. So now what do we do? You found your dream home. So step 4, you need to work with your realtor to make an offer. Typically those offers have expiration dates, and you'll work with the listing agent to make sure the buyers and the sellers are both comfortable with what you are agreeing on. And then, of course, you want to make sure that you're reviewing that offer with your lender to make sure it has all of the components that the lender needs to make sure you qualify, especially if seller concessions are included. We can update your pre-approval letter as needed. And then, of course, you submit your offer with your earnest money deposit. An earnest money deposit is essentially a kind of a show of good faith. It shows the sellers that you are serious about this home and that you intend to move through the process. And those earnest money deposits typically range from $500 to a few thousand. So your realtor will help you determine that amount. And of course, that earnest deposit will then be taken off from the amount of money that you have to bring to closing. So it will get used later in the process. Step 5, after your offer is accepted, the lender will order the appraisal. The appraisal will make sure that the home is worth what you're intending to spend on it. And then you will work with your realtor to hire an inspector to come out, walk through the property, tell you and show you any things that may need to be fixed, any areas that may not be up to code, um, things like that. So you really know the condition of the house that you're buying. Appraisals are mandatory. Those are required as part of the process, but inspections, depending on the loan program, are sometimes optional. So again, work with your lender, ask those questions to make sure you're doing all of the appropriate steps. Also at step 5, we collect any updated documentation. If it's been a few months since you got pre-approved, we may need new bank statements or something like that. And this is also the time where you get your homeowner's insurance. Again, if you don't have an existing relationship with an insurance agent, that is something we can recommend to you. And then your loan is reviewed for final underwriting. Step 6, this is the most exciting part of the process because you receive your final loan approval. You review the closing statements and coordinate with your lender. These statements will show you exactly how much you're borrowing, your interest rate, the dollar amount that you need to bring to close. And then you, of course, attend the closing, or in today's COVID world, you may do that kind of a drive-by closing in your car, but either way, you're signing the documents and eventually you're getting the keys to your new home. And again, make sure you're consulting with your lender before making any big purchases or any job changes while you're in the middle of the purchasing process. So we covered a lot of information tonight. I hope that I was able to answer your questions. Just to do a quick recap, we talked about the benefits of owning versus renting. We talked about the pre-approval process, your credit report, your credit score, how that's calculated. We talked about the different down payment options. And we talked about closing costs, what those mean, what those are. We covered the 4 loan programs that we tend to work with most often at Michigan Mortgage. We talked about your mortgage payment, what that includes. And of course, we reviewed the 6 steps of the home buying process. Now is the time to ask questions. One of our loan officers, Rob Garrison, has joined our call. So he is here to answer anything that I didn't touch on, or maybe I don't necessarily know. So unmute yourself, use the chat feature, anything you'd like to do to get this process started and let us help. All right, so it looks like we have a question. This question came from Sean. So do we have any tips on repairing credit? Sean, we have a ton of resources on the blogs portion of our website when it comes to credit, but some of the things that our loan officers and our LOA suggest is always trying to keep those balances below 30%. That will really help improve your score. If you don't have a score, a secured credit card is one of the first steps you can do to getting a score. A secured card, you put money down and then you pay it off every month. And of course, making sure you're making those payments on time. Rob, anything you have to add on repairing credit or tips for first-time homebuyers?
Yeah, the key, the main key, you hit on it, is to get a revolving account. 1, 2 is actually better, and keep the balance as low as possible and have a 6-month payment history on it. That really is all that it takes to actually establish your credit score. Yeah, so if the credit is in such a shape that you have a lot of derogatory stuff on it, just paying those things down or off is not necessarily the ticket to be able to get the highest credit score. Sometimes it's actually easier to go through a credit repair company, and we can recommend one of those. They do charge to do that, obviously, but that is a good way to kind of dispute some things off and kind of get a restart on the credit.
Yeah, definitely. Thank you. Any other questions, concerns? Yeah.
Can I speak instead of typing?
Yes, absolutely.
Okay. This is really simple and very basic, but probably one that you've never been asked. Um, my wife comes from a foreign country,
Okay.
so before we married and before she came here, she had no credit.
Hmm.
After I had a business, I've paid off, I don't know, 5 or 6 mortgages. I, I have a very long credit history. She had none. So I thought, well, we want her to have some credit on her own. What happens if I get killed in a plane crash or something like this, and then she's bereft and has no credit history. So I got her credit card. 10 years go by, been paying on it all the time, perfect payment history. Guess what? She has no credit history because the credit card was in both our names, and they're really only looking at me. It's only been in the last year that we've sort of realized this is actually a difficult thing. She wants to buy a house. We're both interested in this, but we want her to do it separate from me. Is it possible for her to do that? I mean, we're married, we file taxes together, but we want her to have a credit history, and we want her
Yeah,
to have a sense of it. She's working. I'm retired now. I want her to be able to function on her own. She has a
I,
job. She should be proud of herself, right? She should be able to have her own things.
I
Um,
I can I can answer that real quick. So, the fact that it was in a joint account, that actually should not have prevented her from getting a credit score. Now, if you're talking about her having it, she was an authorized user, that might be different. So, all it would take again is to get a credit card for her, and if she can't get a normal credit card, get a secured credit card for her, and then 6-month pay history on that will establish a score. Until she has a score, she's not going to be able to get
okay,
finance.
we've done that. We're probably 4 months into it.
No, a
Um,
month, two.
oh, okay. I thought it was longer. Okay. Anyway, the beyond that is buying a house, or actually, I think what she wants to do is buy land. Well, we're considering all kinds of things. Um, is it possible for her, as a married woman, married to me, to get a mortgage that is in her name? I mean, it was the
Yeah,
case when I got the mortgage for our house, it was in my name. Seems very male chauvinistic thing.
yes,
We're
yes, yes.
married, and they don't consider her a person at all. She's not even there.
Yeah.
And so I'm
She
thinking,
can
if
get
they can do
finance.
that for me, why not her do that for herself?
She can get financing in her name as long as she has a credit score and income to qualifying income, and she can qualify by herself without her husband. Absolutely.
Great.
Yeah.
Because it seemed like we were, because my financial, whatever you call it, it dominates. It's just kind of automatic. So we go to a bank, we talk to them. My language skills are a little better than hers. Then they start drawing me into the process, and it seems like it's impossible to get to what we want.
Yeah. She can
So
apply by herself. We're not a community property state. She's got her own separate credit, and she's got her own separate debt, and she's got her own separate score. So that's not a problem.
that's what she wants to do. I'm hoping that we can find a lender that will allow us to do that, or that won't sort of background ideas going in their head, not agreeing with what we're actually trying to do, and then doing things. I mean, when you get to a closing, it's very hard to read through that much paper and find out what's really there. When we closed on the house that we're currently sitting in, I told them explicitly I wanted her name in attached to the home. Nope, didn't happen.
Hey,
They just
Courtney,
assumed that that's what they should do, and you know.
Yeah.
Courtney, go ahead and get this gentleman's name and information, and we can talk to him about that. Because yeah, we can help him. But let's take this offline and go to the next question.
Okay, I'm sorry. Thank you.
We'll
No,
take care of you.
absolutely. Yes, yes, definitely. Okay, so a couple more questions. So one question we got is, once you get the pre-approval amount or your credit is pulled, if you don't find a house right away, do you have to continue doing that process to get another approval? So Rob, correct me if I'm wrong, but once you start the process, you get pre-approved, we pull your credit score. I believe that pre-approval is good for 60 days.
So actually, there's no time limit on the pre-approval, but things start expiring. So credit reports start expiring after 90 days, bank statements, pay stubs, things like that. So you just have to update your stuff. So basically, the main thing is the credit report. After 90 days, it's either 90 or 120, depending on the loan type. You have to repull credit. But yeah, there's no really time frame for the pre-approval itself. It's just that the stuff that gets you pre-approved starts expiring.
Right. Yes. And Sean, I will reach out to you directly with some recommendations. Um, so we also have a question from Angela. So do we recommend mortgage shopping? And how do you just secure a lender if you have shopped around?
You want me to take a stab at that?
Yeah, I think so.
Yeah. So my opinion is that you find a lender that you trust and that has a good reference from somebody and that you have a good rapport with, and stay with that lender, and ask your questions, get your questions answered through that lender, and not do this whole thing with going through multiple lenders.
And then when it comes to securing that lender, essentially, as soon as that lender pre-approves you and gives you that pre-approval letter, that relationship is then essentially established.
Is that an answer or a question?
Answer.
Yeah. So I mean, yeah. So once you have the relationship in the pre-approval, what you don't want to do is start getting multiple opinions about multiple different things, because it gets very, very consuming and confusing. And I think what you want to do is stick with, honestly, people are grabbing interest rates from the same place. You're going to have such a nominal difference most of the time, as long as you're going through a reputable bank or lender. It's not about really rate and fees anymore. It's just about relationship. So
Yeah, absolutely. Any other questions, concerns? Again, after we conclude today's session, I will email all of you individually. So you'll have my contact information, which will give you another opportunity to ask questions. And I can of course connect you directly with one of our loan officers or loan officer assistants, and they can really walk you through the process and get into more detail with you.